Two big events this week. CPI came out on Tuesday, and CPI was a little calmer than anticipated. Came in at 7.1% year over year, but only 0.1% month over month. So the rate of inflation has clearly slowed. The unfortunate problem with this data is that energy was one of the key components and actually went down during the month, is about to reverse and head back up on an inflationary basis. So energy prices have come down for two primary reasons. The COVID lockdowns in China have dramatically reduced demand for oil in China. And secondly, the Strategic Petroleum Reserve release of about 1 million barrels a day has created extra supply and helped depress pricing. Those two items are about to reverse, and this should reduce supply and increase demand, and we think that energy prices for crude oil should be dramatically higher next year. In addition to that, as we approach winter, heating season, natural gas usage goes up, and in addition to that, this year we are trying to ship as much natural gas to Europe as possible. So two items for the natural gas, so we expect that to actually have a surge as well. So energy component of CPI should reverse out and head higher. And then there was this very funny component in CPI where they said healthcare medical services went down 0.7% month over month. This is strictly a statistical anomaly as the mix of services post-COVID has changed and is picking up data that's not quite there. In the real world, hospitals are trying to raise their prices this year in order to recoup their significant losses during COVID. So there is no way that data is actually accurate. That's a false number, and the healthcare component will eventually swing back to positive once they get this statistical anomaly swung out. So inflation, although very low last month at 0.1% month over month, should reaccelerate here, and we should have higher year-over-year numbers over the next few months than the 7.1. So inflation is definitely not behind us. The market sort of felt like it was for a moment there, and we did have a brief rally, but that has since reversed out. The Fed followed up on Wednesday with its announcement of the highly anticipated 0.5% increase in the Fed funds rate. That was widely anticipated. What was not anticipated is the Fed's hawkish rhetoric to stamp out inflation and bring inflation back down to 2%. They raised their forecast for how high rates needed to go next year and in the out years, raised the longer-term rate for inflation, and raised the unemployment rate while lowering GDP. So the Fed clearly thinks we still have an inflation problem and is moving to address that issue. I agree that the inflation problem is not going away in the near term. It's going to be very difficult to get inflation under 5% given the massive increase we had in the balance sheet, also coupled with these out of control federal deficit spending that has caused the debt to balloon to over $32 trillion, not counting unfunded liabilities for Medicare and Social Security. So inflation is a longer term problem. I think it's a secular issue that's going to be with us for a while, and the Fed is going to continue to fight it. And unless you can get the fiscal house in order, it's going to be a very difficult fight. So in addition to that, quantitative tightening, which is the chart I have behind me, this is the Fed's balance sheet. The Fed's balance sheet has started to contract at about $95 billion a month. This is what the Fed has promised. They did get off to a very slow start, but since September, when they increased to $95 billion a month, they have accelerated their pace of balance sheet reduction, on QT. QT takes bonds out of the, cash out of the system and makes less liquidity in the system, makes the price of bonds go down, makes the liquidity in the system available for other types of purchases tighter, and this program will continue at $95 billion a month until something breaks. So I think we're still relatively early in QT. I do think that the Fed will continue to do $95 billion a month until something breaks. So I advise caution with regard to your stock allocations. That is what I'm doing for myself. I currently have a significant amount of cash in my portfolio. I hope you find this information helpful. Please remember, this is not investment advice. Please take a look at our full disclaimer on buildingbenjamins.com, where you can also sign up for text and email alerts so you get this information on a timely basis. Thank you.